Okay, let's talk about systematic and unsystematic returns, and then we're going to come back to efficient frontier in a minute. So we have two different types of returns that we need to think about. First one is systematic returns. These are non-diversifiable risks. They affect a large number of assets. They're things such as changes in GDP, inflation, interest rates. You can see that that goes nationwide, it goes worldwide, it affects all the assets together, so they all get hit by GDP, they all get hit by unemployment, and they move up and down for those reasons. But we also have unsystematic returns. An unsystematic risk or unsystematic returns are risk factors that affect a limited number of assets or just one asset. They're unique risks and asset-specific risks. For example, a labor strike or a parts shortage. The other thing could be an accounting irregularity. Remember, we had a few firms that had accounting irregularities. Those are individual instances that only affect those companies. They don't go across the nation. They don't go across the world. They don't impact others. So you've got this idea of we've got systematic risk that we can't diversify away. And then we have unsystematic risk, which if we have a number of stocks in a portfolio, we limit that risk to that one particular instance, which can be a very, very small part of our portfolio, so we can get rid of that risk in our portfolio. So when we start thinking about this, we talk about diversification and portfolio risk. We can substantially reduce the variability of returns for diversifiable risks and reduce our risks because we can diversify the unsystematic portion of it away. So let's look at that in mathematical terms. The portfolios, if we have a number of stocks in the portfolio is 1, the standard deviation of the portfolio would be, say, 49.24%. And, of course, the ratio of the portfolio standard deviation to the standard deviation of a single stock is 1 because it's 1 divided by 1. Well, if we start adding stocks to the portfolio, 1, 2, 4, 6, 8, 10, 20, and so on, we can see that the average standard deviation of the portfolio, this is just stocks, starts to get lower and lower. So if we're talking about 2 stocks, our standard deviation is 37.6. We get up to about 10, and you see our standard deviation gets to be about 23.93. 20 is 21, 30 is 20. It starts to really flatten out there. And even if we added 1,000 stocks at the bottom of this chart, we'd still have a standard deviation of 19.21. So the question here you have to ask is, how many stocks do you want in your portfolio to make sure it's diversified? Well, if you look at this, you clearly want more than 1, 2, or 4, even 6, 8. You get to 10, you know, the difference between 4 and 6 is, 6 is 26% volatility, standard deviation, and 10 is 23, 20 is 21. So 20 stocks in a portfolio versus 1,000 stocks in a portfolio doesn't save you but 2% standard deviation. So why would you worry about 1,000 stocks in your portfolio? Well, maybe you're in an index fund that's 500. Well, 500 here is 19.27. If you're picking stocks in your own portfolio and you diversify them, you can diversify all the way down to, say, 10 stocks. It'd be 23% standard deviation. So you can diversify away a lot of your risk by picking different stocks in your portfolio, different diversified stocks in your portfolio. So let's go past that to the next slide. If you look at this, you can see that 1, 2, 3, of course the bottom is number of stocks in your portfolio, and the portfolio risk is in the vertical axis here, your standard deviation. So 1 stock, high standard deviation, 2, 3, 4, 5, and it's approaching the non-diversifiable risk. So the non-diversifiable risk, you can't get all the way to 0. You're always going to have 19.2 or 19% volatility anyway, but you can diversify a lot of it. So the question is, how much of it do you want to diversify away? Most people, if they're going to pick stocks, can't watch 1,000 stocks. They're only going to watch so many. Most people would say between 30 and 40 stocks diversifies your portfolio plenty, although more than that, most mutual fund managers are holding 100 or so stocks in their portfolio, could be more. So they diversified away quite a bit of the unsystematic risk, the systematic risk of one company going away. So look at it this way. If you have 100 companies in your portfolio and one of them goes bankrupt because of an accounting fraud, you can only lose 1% of your money. Well, that's a pretty diversified portfolio. You can live with that. Well, if you have 20, that's 5% in each stock in your portfolio. Picture a pie, 20 pieces of pie, that's 5% in each one. If one company has an accounting irregularity, you could lose 5%. So think about how much you are willing to lose. If you think, say, 33 stocks, 3% in each, 33 stocks, 3% each. If a stock goes down and all of a sudden it blows up and goes bankrupt before you can even get out of it, you lose 3% of your portfolio. Well, most people can live with a 3% loss if a company completely blows up. So start thinking about how many stocks you'd want in your portfolio. You can diversify away a lot of risk, but you can't diversify away out the economy, which is the overall stocks moving up and down. But you can diversify the rest of it. The other thing here is total risk. Just to summarize this, total risk equals systematic risk versus unsystematic risk. The standard deviation of the returns is a measure of total risk. So well-diversified portfolios, unsystematic risk is very small. So what you're trying to do is if you're going to try to build your own portfolio, you try to put things that are not correlated at all together into the portfolio so you get diversification, and then you want to hold on to a number of stocks that you can, the minimum number of stocks that you can, so you can watch them all. So most people think 20 to 30 to 40, somewhere in there is the number of stocks you should have in your portfolio. Now, if you want to get aggressive on it, you can go less than 20. Some people go as less as 10. 10 stocks is 10% of your money in each stock. So that would be quite risky, but it's easier to watch 10 stocks than it is to watch 20 or 30 or 40. So it's up to you if that's what you're going to do. Again, I suggest you go to index funds and not do any of this, but if you want to pick stocks, remember to diversify your portfolio. We'll talk more about that coming up.